You can be a student or an institutional investor, but anyone can lose their keys to their crypto. Today, we dive into the sensitive nature of custody solutions for enterprise, for individuals. Are we there yet? Is trust still an issue? And what happens when you lose access to your crypto? Whose responsibility is it? These are all questions more and more institutions and investors are searching answers to in Asia and beyond. Welcome to Word on the Block, the series that takes a deeper dive into blockchain and all the emerging technologies that shape our world at the intersection of business, politics, and economy. It's what we cover right here on Forkast.News. I'm Editor-in-Chief Angie Lau. Just like a safe has a combination lock, crypto is secured with keys of its own. And just like a safe, you can sometimes lose or forget your password, and therein lies the issue. Today, we are joined by Israeli-based institutional custodian Fireblocks, who works with more than 100 financial institutions and, according to the firm, secures more than $150 billion in digital assets every month. Now, Fireblocks was recently sued by one of its clients, staking platform Stakehound, who claims that it lost access to more than 38,000 Ether and that Fireblocks bears responsibility. The bigger picture here is, what does this say about the wider industry? It's a growing industry, custody solutions. It's also one where chain of custody can be murky, and then who's held responsible? Well, joining me today is the CEO of Fireblocks himself, Michael Shaulov. Michael, welcome to the show. This is a growing industry. This is a growing part of the industry. And in this case, it got a little bit messy. Thank you so much for joining us from your headquarters in New York.
Of course, Angie. Thanks for having me.
All right, let's dive right into it. We caught wind of this lawsuit from one of your clients that said that Fireblocks was in part responsible for it losing access to 38,000 ETH. That's a lot of money. And it's now suing Fireblocks in a Tel Aviv court. Can you get us up to speed here? What happened?
Yeah, so, there are a couple of things that I think were caught up in the media, which are a bit incorrect. And also, there are certain reasons why they were basically brought up like this in the lawsuit. But one of the things that is actually very important to make clear is that neither that client or any other of our clients actually ever lost keys to the wallets. And even that client, all their keys to their wallets are basically backed up, and they're backed up. The way that our system works is that all those keys are being backed up every 10 minutes across multiple cloud providers, across multiple availability zones. And there are also additional procedures in which it's also backed up by third parties. Honestly, it's also the case with this particular client, and the situation is that with all their production environments, they're still using us and they're still using the platform, right? So there was a bit of a confusion in terms of how it was presented through the lawsuit and in terms of how it was interpreted by the media, which I think also it's important for me not only to stress it on behalf of Fireblocks, but also generally speaking on behalf of the entire industry, that I think that in terms of where we are today, from basically providing the base infrastructure for custody technology and the ability to safe keep keys, the industry is in a very mature stage. I don't think that any one of the big providers, us or anyone else, have had any incident in terms of the custody itself. Now, specifically, as it relates to that incident, part of what Fireblocks is really famous of is really sort of enabling, I would say, the cutting edge or the bleeding edge of this industry, right? So there are basically the basic things that most people are interested in terms of, storing their Bitcoin, trading Bitcoin, and things like that. But one of the things that Fireblocks really enables is some of the cutting edge use cases, such as staking, such as DeFi, interaction with smart contracts. And honestly, in the case of this particular client, what they were essentially stretching it into is to something that is called liquid staking, which is a combination of staking and DeFi together. And specifically, they were basically engaging in something that is in the preparation of the Ethereum 2 network that is not even live yet, right? So just to maybe explain to the the audience, this particular case is sort of very so abnormal because what that specific client was operating is like basically on the far edge of what currently this industry is doing. And clearly, when you look historically into almost every innovation in this space, or any other space, I don't know, autonomous driving or anything else, clearly there are risks. And usually, when people operate in this sort of like far edge of the innovation, I think it's like part of their responsibility to understand really well what they are doing and how they engaging and how they're building their products, because clearly they're operating in a very sort of a borderline area where it requires a lot of responsibility not to make mistakes, because some of the things that are being done there are being done the first time, right? So I'd say like
Got it.
this is like the first thing that I want to make it clear, because I think one of the ways that was interpreted by people was that this is common. This is something that is just generally risky if like a super reputable provider like Fireblocks that currently powers about 400 institutions, right? And we've secured to date almost $1 trillion of transactions that can happen to us. Then what does it mean to the rest of the industry? And nothing can be farther from the truth, because essentially everything was functioning properly in terms of the core offering, services, and so on. So this is something that is very important to put out there. Now,
Yeah.
as it specifically relates to what happened over there,
But let me just pause right there, because a lot of the audience aren't so deep into crypto and blockchain to understand the nuance, and we want to keep catching them up, because you're totally right. The headline is really scary, right? You've got 38,000 ETH. It's today worth $90 million. One company says, hey, I lost my keys, right? And I'm going to sue Fireblocks, who I've been working with, because they were supposed to help me with our keys. That's really just what the top headline is. The nuance is so much more important. You're totally right. It's not, here's a 38,000 ETH. I'm going to stick it somewhere where most people, they have it in a hard wallet, cold wallet, or if it's a hot wallet, if you're holding it with a custody provider, a custody solution, and or you have your own wallet that's a USB, and you stick it in your pocket with some passwords. We're not talking about that here. In this case, what you're saying is that this is cutting edge stuff. There was staking involved. This is a staking firm. They're looking to leverage. They're looking to play within the margins of 38,000 ETH. Whose ETH is it? Are you leveraging your clients, et cetera, et cetera? This is part of their business innovation that they were working with you on. So to be enormously clear, we're talking about the gray space right now.
Yeah, we're talking about something that was in the space. This is probably like the sub 0.1% of the activity that is being done, that is so far out from what I would say most institutions, most people are actually engaged in. Not that it's not important. We are not talking here about real crypto, real money, right? But I think that it's important to stress to people that the infrastructure and the ability of providers like ourselves to really secure large amount of funds, with insurance and all the procedures in place, that is actually like pretty safe capability today. Now, specifically, how innovation need to proceed in this space. I mean, the space is continuously disrupting itself, right? So this sort of like 0.1% of the experiments that are being done are important. Historically, of course, we've seen quite a few incidents. Then during those experiments, things were lost or stolen. But again, it's not like the common situation for most investors that are operating in the space.
Got it. But let's dive into that a little bit deeper. If the keys were not lost, where is this access to 38,000 ETH? Is that lost forever?
So that's a good question as well. It's still sort of a so maybe I'll explain the overall procedure of in terms of what's going on with Ethereum too. So in general, there is this concept in which specifically with Ethereum 2 staking that is also very different from regular staking is that it's less of a staking, it's a bit more like a wormhole. So the Ethereum Foundation is basically, or the Ethereum community is building now Ethereum 2, which is sort of a new network that will be available, hopefully available within somewhere between the next 10 to 12 months from now, or sorry, 10 or 15 months from now. And we all hope that they will be able to pull this. And essentially, the way that this activity is being done is that you sort of send your assets into an escrow that in due date, this escrow is on the blockchain, it's in a smart contract. It's basically an autonomous vehicle on the smart contract that hopefully, if the Ethereum Foundation will be able to pull off the Ethereum 2 network, your funds will be released with an interest into this new network. Now, in order to release those funds into that new network, in a year and a half from now, you'll need a specific password that for a certain period of time, at the Ethereum, the way that Ethereum engineered it, it actually required a specific new algorithm that was not off the shelf available in the community. That is called BLS, but it's not the algorithm that is being used to secure the standard Ethereum wallets or Bitcoin wallets. It's basically a new algorithm that they wanted to use. Interestingly enough, about a month after this incident back in March, they actually withdrawn the requirement of using it because it was so new and people actually had issues with it unrelated to this specific incident. There were broader issues around it. So what happened in that particular case is that there was some form of deviation from the protocol that was agreed between the parties. I don't really want to get into the specific over there because clearly there is a court case, but there was a significant deviation. I think that basically the protocols and the the procedures that were socialized were not followed in a strict way, and eventually part of that password is basically lost. Now, what will happen eventually? It's actually still unclear because, first of all, the Ethereum 2 network is still being built. It's unclear if they will actually modify. They already modified the way that it works once. Maybe they will modify it again. It's also unclear what will happen if they eventually won't be able to pull off the Ethereum 2 network. Those funds will be returned to their original senders. So I think that there is a pretty that just to basically explain how innovative what we are talking about here and how potentially uncommon it is compared to all the other things that are being done here. Now, needless to say that when you do something that is so non-standard, I think that there need to be a lot of procedures in place to how to operate with innovation. It might also be important to think on. I think there are a lot of lessons learned here. For example, one of them is if you're really operating at the edge of the innovation, is it actually responsible to throw that amount of money into a single key, right? Should you basically break down your risk a bit? So there are, I think, a lot of lessons learned over there in terms of how to operate at the edge. But I think most of our customers or all of our customers are actually not operating on that very edge.
It's the edge that makes it exciting, no doubt. But to be clear then, we've got about $90 million worth of ETH right now. Eventually, will it show up?
Eventually, if it will show up, I think eventually it's still unclear what will happen there. But there is a probability that it won't.
All right. That's essentially what we're talking about. and that will obviously be determined in court. And the other thing is, will a Tel Aviv judge, and I don't know if there are jury cases in civil cases in Tel Aviv, will a judge or even your attorneys be able to really explain this clearly? We're talking about such innovative space, and most people are still catching up to what blockchain actually is. Do you think that in a court of law, you're going to be heard?
I mean, I think it applies for both parties, right? And I think that we would need to basically see. I don't think that it's not that there is lack of challenges overall around this, right? And clearly, there will be a lot of education that would need to be put in place in order to for both parties to introduce what happened and what do we think is the liabilities. But it's far from being it is probably a fairly innovative case given the fact that it's non-standard. Having said that, I think in other jurisdictions, it's other players. It's not sort of like it's not the first lawsuit that exists in this space.
This is true. This is very true. I want to get to, you've been playing in the innovative space for a very long time. As a cybersecurity veteran, in your previous incarnation at Checkpoint, where actually your introduction to this space led you to founding Fireblocks. And this happened back in 2017. Hackers stole from South Korean exchanges to the tune of $200 million worth of Bitcoin. And that's where you saw the opportunity. Tell us more about just how important cybersecurity and custody solutions were for you and your co-founders.
I think it's foundational for this space. Just to reflect on what we discussed so far, right? The aspect around the control over the private key and the ability to basically secure this password can have significant implications, and not only around the particular position of an individual investor or the individual or the individual institution that is in the possession of those funds, but I think that basically all those hacks eventually, when they undermine basically the ability of the ecosystem to propagate into the mass market, right? Because people, the mass market, the retail market, the consumers, they don't really understand cybersecurity. We don't need to basically go into the extremes of crypto to realize that a lot of money is being stolen, lost, data is being stolen, lost, because consumers, just generally speaking, don't understand cybersecurity, and that applies. The losses in the traditional financial systems are much greater than anything we're actually seeing right now in crypto, right? Just to reflect on that. So our mission is really to make it much simpler and safer for institutions to operate in crypto, because we do believe that there is a transformational capability around blockchain on financial institutions, on financial system, on inclusion, on removing counterparty risk, which is extremely important. And in that mission, a very critical part is really establishing trust, establishing the access to the technology that makes it all secure. And I do think that eventually, while the end consumer and the retail on the long run is probably the most important possessor of the asset, I think that for a long period of time, it actually, the institutions will be the gateway, right? In order to really bring it to the masses, we need the banks, we need the neobanks, we need the exchanges, we need all those entities to be able to operate at efficiency, and they also need to be able to operate in across some of the more interesting use cases that I think blockchain brings, right? Because how to secure a long position on Bitcoin, that's fairly simple. You can basically print a paper wallet and bury it under the tree in your backyard, and that will be reasonably secure. But how to bring this into a very transactional market where we're talking about real-time payments, we're talking about replacement of FX, we're talking about central bank digital currency and clearing of digital securities, that's actually more challenging because here we actually need to merge speed and convenience with cybersecurity. And anyone that his antivirus was sort of like crunching his CPU when he had to do something that is important knows that usually cybersecurity or security and convenience and speed are fairly contradictory, right? And I think what Fireblocks was able to do really well is to bring those things together and merge them.
And you're doing that right now for institutional clients, including BNY Mellon. And, I said in the intros, more than 100. You're actually correcting me in saying it's 400 and now close to $1 trillion in digital assets. Tell me about those clients like BNY Mellon, like institutional names that we all know. What are they doing in this space? What are they asking you to do for them, for not only potentially their assets, but also their clients' assets? What is the demand right now from institutions? Yeah.
Yeah. So interestingly enough, I think that all the major banks, they have now initiatives to basically establish technology, the base of the technology, to operate with digital assets. I think that when we started the company at the end of 2017, 2018, there was a lot of interest, but as the market sort of collapsed after the ICO boom, most of those initiatives were basically, um, cleared and deprioritized. What we're actually seeing right now is true movement that is being led by the senior leaders in all those banks, and I'm talking about traditional financial institutions, to establish capability because of, I would say, three main reasons. The first one is that they're actually feeling the heat from the newcomers, right? So when you look at companies like BlockFi and Celsius and Coinbase and I'm actually looking at all the sort of more regulated entities, that it's very clear what they're doing, and it's clear that that you cannot sort of dismiss them because it's they're operating on the edge. They will, like, the regulator will come after them. I mean, Coinbase, no one is already, I mean, maybe the regulator is overseeing Coinbase, right? But no one is going to I don't think, I think it's fairly clear that, like, they're here to last, right? So
Yeah.
I think they're basically feeling the heat, and they understand that they need to act and they need to establish capability to, first and foremost, protect their business and to protect the capital that they currently have, right? Because if people are buying, Bitcoin or they're buying a stable coin, there is a capital outflow from those entities. And not only that there is a capital outflow, you're actually seeing a lot of those entities coming into the old business, right? So, example, like BlockFi is launching a credit card program, right? So the it already becomes fairly gray, in terms of, are crypto institutions or are actually real financial players. So that's sort of like the first, I think, the first thing that they see, and they also see a very big client demand, at least from the high net worth individual client base and from their institutional client base, to provide this kind of services. And the second thing that they see over there is really the business opportunity, right? So a first mover advantage in this market can actually mean quite a lot, right? Because first and foremost, the margins and the profits in this market are very high compared to what they're seeing in their core business. Maybe the market is not as big as their core business, but the margins are very high. And the
Yeah.
second thing is that the being first mover allows you to interact with the regulators and interact with the definitions and the specifications for the broader, I think, for the broader mission here, right? If we talk about central bank digital currencies, if we talk about digital securities, if we talk about payments, being a first mover over here really allows you to define the rules of engagement and potentially, like, place yourself in a position where you can, not only that you can preserve your place as a dominant financial player, but actually sort of front run your traditional competitors.
Well, I would argue that theoretically is spot on. Realistically, it really depends on the jurisdiction that you're in. People's experience in Asia is very different than people's experience in the United States, for example. First mover advantage is not necessarily your friend in specific regulatory jurisdictions. So I would just say that. But you're totally right. To your point that a lot of the institutions, the banking names that they are being challenged by the aptly named challenger banks and the challenger crypto players who are also now in this regulatory space. So, and in fact, we're seeing a lot of veterans from traditional banking get into crypto. I mean, in terms of first mover advantage, I think it's actually the leadership, that the brain drain almost from traditional finance into crypto, using the experience that they have in regulatory and compliance and AML, KYC, and all of those things, knowing who the regulators are, knowing, having worked with compliance officers for decades, knowing all of that landscape and bringing it to the crypto world and creating a discipline there.
Yeah, I agree. We're seeing a lot of people moving into the space from the banks. I think that and hedge funds, right? I think that people understand the opportunity. People also understand the advantage of an infrastructure that is being set up from the ground up to support it. I think that one of the challenges, definitely one of the biggest challenges that we see more on the technology side is around how do we integrate our technology with the more traditional system, with the core banking platforms. And those are pretty complicated projects, because generally speaking, most of those banks, they have a fairly substantial technology debt, right? When you look at Coinbase and when you look at some of Binance and all those providers, they're fully cloud, continuous delivery, continuous integration. They are set up with a modern infrastructure for the 21st century, or I don't know, like for the second decade of the 21st century. Whereas one would argue is that you have a pretty decent amount of banks that their infrastructure is currently set up for the 90s, right? And they need to basically leap. They need to make several leaps, right, in order to be able to consume and integrate this technology.
Who do you think is doing that better, geography-wise? I note that you're expanding in the Asia Pacific. As you expand globally, you're there in New York, obviously with the big, the center of the universe when it comes to the top financial firms in the world. But increasingly, all the money, there's significant money here, there's significant innovation here. Who does it better, in your view? Or who has the potential to eventually do it better?
I think that, again, I would actually say that the Asia Pacific is somewhat a newer, right? A newer market for us. We've entered that market last year, right? Like pretty much like 12 months ago. I do think that there is a lot of opportunity and potential in the Asia Pacific market. Clearly there are jurisdictions in the Asia Pacific market, such as Singapore, such as Hong Kong, I think, in Thailand, that there is a fairly tight cooperation between big commercial institutions and the regulator. And also, it's very clear who is the regulator, right? So, which is also helpful. So that gives those institutions some kind of potentially an advantage, right, compared to their American peers, right? In the United States, it's not a secret that there is a large amount of regulators, and it's not always clear, or in most cases, bigger financial institutions, they have at least handful of regulators that they need to clear, right? And that makes things challenging. I also think that, at least from the little that I've seen so far, that in some cases, the Asian institutions, they have more modern infrastructure because to a certain extent, they started their digitalization journey later, right? So when you, for example, you look at the different core banking systems that they use, they are actually the newer generation of platforms that are, in some cases, are actually even cloud-based and so on, compared to sometimes, like, 40-year-old infrastructure, like, IBM infrastructure and things like that, that you would see in the United States, in Europe, right? So that makes things a bit easier.
That is a great point. Anyone who has flown through LaGuardia will understand this metaphor in New York. You're flying into the biggest city in the United States, LaGuardia, and there are smaller airports in Asia that are light years ahead in terms of modernity, efficiency, all the rest. I don't know if you've ever flown into LaGuardia.
Yeah,
Michael,
I mean, I
but
don't think you need to go up to LaGuardia. I think you just need to basically flow to JFK and the Singapore airport, right? Yeah,
night and day.
yeah.
Even Kolkata, India, which I had the pleasure of flying through. Believe it or not, I mean, just the impression that people have when you're flying. Oh, you're flying to Calcutta, India, and you should see this airport compared to LaGuardia. Anyway, I digress. But your point is well taken. Asia has leapt ahead in terms of being at the later stage of digitalization. We are also seeing, a lot of countries hoping that blockchain will allow it to leapfrog in the development, economic game. We have heard very clearly from China that blockchain is going to be integral to economic growth and is part of their strategic implementation and investment, in a way that we aren't really necessarily hearing about that from the West. More from the private side, but from the government side, less so. Does that make your job harder?
The simple answer is yes. Because from our standpoint, we have right now two missions, right? The first one is really to support the innovators, right? And we are working with the most important crypto native firms out there, supporting them from an infrastructure standpoint. And that's, I think, integral to making sure that we continue and basically linearly grow this ecosystem. The nonlinear growth really will come from us helping to drag in the big players, right? The big banks, because once you have a big bank that is coming in, they come in with the reputation, they come in with the clientele, and it's much easier for them to basically bring more money to the table. And honestly, also they sit on most of the assets in the world, right? Clearly, the regulation, risk, and compliance are the main gates right now for this to happen, right? So we do spend a significant time with the regulators, educating them, and a lot of the stuff that we are doing is really trying to smoothen it out, right? But I think, in reality, this is what makes this process take, think like, 12, 18 months and not, 3 to 6 months, right? As you would assume. Because I think that from business plan standpoint, from incentives, from aspirations, it's all there, right? Now you basically need to clear gates that are risk compliance and regulation, and that's challenging. Yeah.
Yeah. The Bitcoin volatility, the prices in crypto, we experience the highs of the highs, and now those institutions and those publicly traded firms are now reporting that some of their crypto holdings is now putting them in a loss position. Has that dulled or kind of left some cold feet from institutions picking up crypto, getting into this space?
So I was actually concerned about it about a month and a half ago. Shared that concern actually with my team and with our investors. And to my surprise, the answer for that is no. And I'm basing it not just on sort of people that might have just very narrow incentive. It's based on conversations with the number twos in some of the biggest banks in the world, and I asked them that question specifically. They said, look, it's not helpful, but this is not the reason why we are doing it. The reason why we are doing it is because of the really big picture of not only Bitcoin, and is the price of Bitcoin is 30,000 and the price of Bitcoin is 60,000. And honestly, unlike other people, I don't know how to predict where Bitcoin is going to be in a year from now. And I'm a cybersecurity professional at the core. I'm not a financial analyst, so I leave those predictions to other people. But what I can definitely say is that the reason why those people investing and the reason why those people are committed is not because of the price and because of the FOMO. It is because they see a real opportunity that we discussed earlier around, being first, second, third mover. It doesn't matter, right? But basically being in the leading pack around it.
That's and back to where this all started. Whether it'll be figured out in a lawsuit or otherwise, we're talking about cutting edge space here. And so what is next for Fireblock, for this industry? You're working with some of the top teams in the world, both on the institutional side and on the blockchain side. And now we're starting to see DeFi, institutional interest in DeFi picking up. Where are we headed to? Where are we headed to when it comes to this space? So you sit at the cusp of all of that.
Yeah, so I think that the institutionalization or institutional access to DeFi is probably within the two most strategic things that we're currently investing a lot of our resources. I think that there are still a lot of questions, and we are now, I would say, running a few, small scale experiments in terms of figuring out how to make it accessible to both different layers of the institutional segment and through different type of products. And most of it is really around, I would say the two main challenges is clearly, one is the regulatory challenge, right? The compliance, and which is just unclear. It's in flux. I think that there are many people that are smarter than me that can talk about all the FATF and FinCEN and what they're going to do, what they're not going to do. But there are real concerns over there that I think there are real concerns from the regulators that need to be addressed properly, and there are also real concerns from the community that they want to see innovative solutions that align with the behavior of the signal or behavior of this asset class, and not someone coming in with a solution from the 70s that doesn't even work for the traditional financial space and tries to apply it to a new technology. I think that there's still work to be done, but I think the regulatory aspect is one, to basically make people make a high-end, highly regulated institution more comfortable joining in. And the second aspect is really making it seamless, right? Because right now, to operate with DeFi, and again, to reflect to the lawsuit and what we discussed, although DeFi is clearly less risky than what was done over there, but it's still cutting edge. There is still a lot of with Fireblocks, without Fireblocks, there is still a lot of technology risk that is associated with smart contracts and the access to the smart contracts and unexpected behavior of those things. And we do spend a lot of time in terms of figuring out what is the best way to make this accessible to the public, to the institutions, and how to make it as secure and seamless as possible.
Very famously said, it's the known unknowns that we are living in at this moment. And I'm going to apply it to the technology space because that is exactly what I think what defines how exciting this innovation space is. Michael Shaulov, it was a pleasure talking with you. And thank you so much for joining us on this show and sharing a glimpse as to, what is truly cutting edge and what we'll be able to see in the next 12 to 15 months. Appreciate it a lot.
Thank you so much.
And thank you, everyone, for joining us on this latest episode of Word on the Block. I'm Angie Lau, Editor-in-Chief of Forkast.News. Until the next time.